What is up, everyone? Welcome back into the trading world. There's a lot to talk about today, including apparently ICTs receiving too much fan mail, which is kind of funny to me. And there's a lot of trades to cover too. So, let's jump right into it. First, what is going on with this? This is kind of funny. Every week I receive mail from students all over the world. It has become excessive, and I can't reply to all of you guys. Please do not send me things anymore. That is like genuinely funny. Like, there are so many students turning profitable because of ICT. You literally can't keep up with it anymore. But anyways, guys, there's a lot to review today. Trades from Dodgy, from Hydra, from Ash Trades, and then a few trades from me. And yeah, we're just going to talk about price action in general, starting with, guys, right in the morning, when we had the market open, we had this giant market maker buy model. Check this out. And we'll go over the afternoon as well because today was FOMC. I'm going to switch to the other screen. And starting out right when the market opens, this was 9:30. So this was the market open. We immediately dump down and perfectly fill, guys, perfectly. Like, this is... See this 15-minute fair value gap? See how this is all perfectly... Like, this is one of the most perfect fair value gaps you can get, right? Check out what happens. Ignore this for a second. We perfectly fill that fair value gap. Guys, you don't get more perfect than that. And people say that fair value gaps don't work. Bro, you just have to know when they're going to work. Check out that fair value gap. That is the perfect fill, the most perfect fill of a fair value gap I have ever seen. And we actually get a trade right off of this fair value gap. And it comes from Dodgy. And this is an interesting one. This was kind of controversial because it wasn't a singular fair value gap. If you guys don't know, typically when you take a trade, you want to only have the fair value gap that gets inversed be one single fair value gap. You don't want to see on the 2-minute, right? This is on the 1-minute chart, but on the 2-minute, this is a higher time frame fair value gap. Typically, you don't want to see that. But because of liquidity, right, we have this giant accumulation range. In my opinion, this trade's actually okay. Typically, you need to wait for all the fair value gaps to get inversed, but because we know that there's going to be a lot of liquidity and consolidations, when we sweep out this low, and once again, guys, remember, we're not just sweeping out a low, we're delivering from a 15-minute fair value gap, which is also this new day opening gap. It overlaps with this fair value gap, making it even higher confluence. So anyway, going down to lower time frame, we inverse this 1-minute fair value gap, and because this is a giant liquidity pool, it's a giant accumulation range, this actually acts like more like a liquidity void than it does a fair value gap. And if you don't know, a void is going to want to get filled, right? Because this is a giant range, we can assume the rest of this to get filled, and the market's going to draw back up to take out the highs of this range. And that's exactly what happens, right? So accumulation. So let's go back. Top, center. Accumulation, manipulation, inversion, and then distribution back up to the high. Now, once again, this one was a little controversial because we do have this external gap here. And you can see my friend Camel talks about this. Check this out. Camel says, I did not enter this. I don't consider it A+ because the inverse fair value gap was not a singular fair value gap, but the 15-minute was too clear. I'm assuming he means the 15-minute fair value gap. So he does end up taking it. And once again, just giant AMD. Sometimes you just have to think about the market in terms of accumulation, manipulation, distribution, and liquidity, and less about the specific rules, right? Think about where was the market accumulating? Where is it likely going to draw back to? And that's the kind of trades you want to be taking, right? When we get this instant dump on market open, I know that's probably manipulation. And then when we inverse this, I know we're probably going to run back to the highs of that consolidation. And boom, we inverse this straight up to the highs of that consolidation. That would be a 1.8 to 1. You would be done for the day. So if you took that, congratulations. And you can see we continue to go higher to take out, what are these? More low resistance highs. So we go and take all those out. Let's move on to the next trade. Now, something I want to talk about that happens right after this is you can see we end up getting a 5-minute BPR here, and see how perfectly the market responds to this BPR, right? We dump down into this BPR and then aggressively come back up. And what happens, right? We get a 30-second change in state of delivery. See this? You could actually mark it out like this. 30-second change state of delivery. What is aligned with the 5-minute, guys? The 30-second. We align the 30-second with the 5-minute. So 5-minute bullish and bearish fair value gaps overlapping with each other. That's a BPR. And then, so 5-minute BPR, then 30-second change state of delivery. And hopefully this is really obvious to you, right? The market perfectly respects this. You see this here? See how perfectly the market respects this? And the reason this is good is because we know this is accumulation, manipulation. So we're anticipating 10 a.m. This is 10 a.m., right? This is going into 10 a.m. We're anticipating 10 a.m. to distribute us higher because that's what 10 a.m. does. 10 a.m. moves the market to where it wants to go. So 5-minute BPR and 30-second change of state of delivery. And that's what aligns with the 5-minute, right? And then if you measure out standard deviations, you can see we go right to the second standard deviation perfectly, right? So if you took this up to that, right, because you want to take it up to probably only there because that's when these low resistance highs end, right? Think about the market in terms of liquidity and not like a random standard deviation, right? These are the low resistance highs. So we want to take profit probably at the end of that, to be honest. So even though maybe you were considering holding to go further, honestly, the low resistance highs end right here. So you could honestly just take this as a 1-to-1 risk reward. Entering like this. Stop loss at the low. Targeting this first standard deviation. That would be a 1-to-1. And you'd be great. Could you have targeted the second standard deviation and hit a 2-to-1? Yeah, but you run the risk, right? So maybe you want to trail your stop, take partials through here. Once again, though, guys, flow state, it's a little OP. And as well, I believe this is, I could be wrong, but I think this is what they call the first presented fair value gap, where I don't know, someone's going to have to let me know if you guys know, but the first presented fair value gap is like the 2022 model, I believe, where you sweep out a low, break of structure, and then what is this? This is your fair value gap. So liquidity sweep, break of structure, and then fair value gap. This is your 2022 model, same one TJR trades, and you can see 2022 model delivers us way higher. And if you guys take the 2022 model, I can't stress this enough. It needs to be obvious. Like it needs to be like there's so many times where it's not going to be obvious and it's not going to work. And I've seen this happen so much. You need to have, if it's a 2022 model, it needs to be a sweep, break of structure, 2022 for value gap, and then you can see its explosiveness off of it. The way you enter is like stop loss here, and then yeah, the rest is history. We go quite a ways. But once again, guys, I'm not trading that right now. I just wanted to take note of it. So anyway, at this point, we consolidate, and then what's this again, right? The market switches modes. It switches back into accumulation. The market is now generating orders again, leaving low resistance highs, right? And then once again, we aggressively deliver back lower, and you might be wondering, well, why was that? Well, if I pull up volume profile, check that out, right? The majority of the transactions are right here. So the market's going to seek this liquidity. The market's going to seek to stop these people out. And that's exactly where it went down to, was right here, this liquidity pool. So there was a trade ICT took in here. If I have time at the end, I might try and reverse engineer it, but I don't know how much time I'm going to have. I kind of want to get this uploaded. Then we get the trade that Dodgy took. Guys, this one as well, very similar thing to the last trade that Dodgy took, where once again, it only makes sense because of liquidity. It only makes sense because of liquidity. So he says, let's see if I can find it. It's just going to take a second. Hopefully it doesn't take too long, because I thought I had it pulled up, but I guess I don't. So just hang on a second, guys. All right, here it is. So you can see this was the trade, right? Similar situation. Normally you don't take trades like this because, you know, external gap, but once again, these low resistance highs, they're hard to pass up on. And so this trade is a very similar trade to the last one, where we get a clear dump and then a clear inversion. And the nice thing is you can go break even at this high, and then we run up to go take out all of these low resistance highs. So going back to the other chart, you can see this exact same thing happens, right? We take this liquidity pool, inverse this fair value gap, and because this is more of like a void. Now, once again, I don't love taking trades like this. I'm in the same boat as Camel trades, where he says, guys, like, it's one of those personal preference type of trades, but if you have conviction that we're going to go to that trend line liquidity, you could go ahead and take this, right? So anyway, we inverse this, and you can see the nice thing about this is it is pretty good risk to reward, right? Where you get the inversion, stop loss goes right here, and we do go and run up to take that entire trend line. Now, you can just take profit right when we get there. That's a 2-to-1, right? And you can even go break even right at this high. So excellent trade from Dodgy. And then right here, guys, this is when the FOMC event happens, right? We get the speaker. I don't know actually when they speak, but this is when FOMC news came out, and this was the data high. And so a lot of people were thinking, oh, we're gonna go right to the data high because it's a data high. And guys, you got to think about the market in terms of accumulation, manipulation, distribution. You can't be brain dead. You got to think about the market in terms of accumulation, manipulation, distribution. Because what is this, right? The market's chopping around. Everyone and their mom is bullish here. They're all like, oh, we got to go to the data high. We got to go to the data high. But what's happening here, right? Orders are getting generated. This is becoming an accumulation range. So focus on the market in terms of accumulation, manipulation, distribution, right? This is the market's accumulating here. So we know we want to target these accumulation ranges. So what happens? We manipulate this high, and all of a sudden inverse this fair value gap. So now it's like, oh dang, is this really the drawn liquidity anymore? Or now that we inverse this fair value gap, are we going to distribute down and take out all these low resistance lows here? And you can see that's exactly what happens when we inverse this. We go ahead and we run down to take all those low resistance lows. Once again, this is a 2-to-1. And once again, nothing in here is obvious. I bet a lot of people probably tried longing up to here, but just once again, because of this inversion here. But once again, we have to think about the market in terms of accumulation, manipulation. You sweep this high, and then this is manipulation, right? So this is where all the people who go long off of this inversion get trapped, and then we distribute back down to go run this accumulation. So guys, once you start thinking about the market in terms of accumulation, manipulation, distribution, you're going to stop falling for these fake inversions, right? Because you'll know this isn't the true drawn liquidity. The drawn liquidity is to distribute back lower. And this is something that, guys, I'm still working on as well. But you can see we do end up distributing back down. If you wanted to not take that as an inversion, maybe you could have taken, I believe this is a 15-minute rejection block. Yeah, you can see this is a rejection block. It's a giant wick. And the reason it's a good rejection block is because we sweep out all these highs when we get this rejection block. So then on the 1 minute, theoretically, could you have taken this as a flow state? Yes, right? Where you have accumulation, manipulation, change of state of delivery, and you can see how perfectly we respond to this change of state of delivery here, right? So 1 minute change of state of delivery, accumulation, manipulation, change of state of delivery. And if I measure this out here, you can see we go right to the third standard deviation. Now, once again, guys, I'd probably just try and target the first or second here. But yeah, pretty cool. So, boom, stop loss here, and then we run down. Yeah, I'd probably just go second standard deviation, and this would be just really, really solid trade. So hopefully you guys can find more of these in your real trading. It's not easy. I'm not saying it is, but these are the kind of trades that are going to eventually, hopefully one day, make you millions, right? The trades that are really obvious: accumulation, manipulation, distribution. Like this, it doesn't get more clear than this. Do you see these low resistance lows? Do you see how everything fits together like a puzzle, right? Accumulation, manipulation, change state delivery, and then we go to the 2 to 2.25. So if you made it to the end of this video, you guys can click off if you want, but I'm going to go try and reverse engineer a trade ICT took because I think it's kind of fun to do that. And so my theory, if I can find his trade, my theory, right? So he basically takes this down to this move down to go run this consolidation here, right? This is, remember this giant liquidity pool here? So he takes this trade down to go run this liquidity pool. My theory is, let's see if this will load. Okay, here we go. He says web slinging, and he takes a short here. If it'll load. Short here, long here, long here. the only thing I can think of that maybe the reason he entered right there. This is just this is a complete speculative guess, guys. Do not take this as like ICT knowledge, but this is just my fun little hypothetical guess. Being a speculative trader, is I think he knew that this was the draw on liquidity, right? Because that was the liquidity pool. It's this signature and price here where you have order block, where you have an order block, and then when you have an order block off an order block, that's a propulsion block, right? These are very, very explosive. So my theory is he used this propulsion block as his higher time frame key level, and then right, so order block, propulsion block, and once again, guys, the market will leave fake liquidity to come. Like this low resistance liquidity, it looks good, but the market isn't ready to go there yet. The market only goes to liquidity once it's ready to go there. And I know that's way easier to say in hindsight, and it's something I'm working on, but the market's not going to go to a liquidity pool until it's actually ready to go to a liquidity pool. And so here, the market was seeking this one. And so what happens here? Well, we get this close below, and at this point it's like, all right, the market looks ready to go, and we have this 1 minute change state delivery. This could be completely wrong here. I really could be completely wrong, but my theory is you can see that this is exactly where he entered on his chart. See that? And he takes it down to here. My theory is I think propulsion blocks are insanely high probability. I think he took this propulsion block, he took this 1 minute change of state of delivery, and then I think he just targeted the second standard deviation. I think that's what he did. That's my reverse engineering of ICTs Trade here. Could be totally wrong once again, but I think it's fun to try and reverse engineer people's trades. And so I was looking at this, and I could see this being the trade that he took. So, like, once again, is this what actually happened? Is this the trade he took? I don't know, but I have a feeling propulsion blocks seem like they're pretty high probability, and especially when you have like fake liquidity like this, right? The market wasn't ready to go to these highs, and so people are going to try and long here thinking we're going to go straight to these highs, but in reality we need to go lower. And you can see, look at this, right? He takes profit right there. Like, my theory is if you're a really, really good trader, this is the type of trade you would take. You take a really high probability PD array, like a propulsion block, and you take a 1 minute change state delivery off of it. I don't know, guys. This is all speculation, but maybe you guys got something out of it. I don't know. But I just like talking and speculating, and yeah, hopefully you enjoyed this video. I'm going to keep getting better with these. I'm sorry if they're not perfect, but you know what? I'm going to try my best. I'm going to try and do a video on the lore between Romeo and ICT at some point. I think that'd be fun, but I'm still working on gathering everything together. Anyway, I hope you guys enjoyed this video. I will see you guys in the next one. Bye.